The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The Fed stands pat, the VIX perks up, and will markets roll over once again? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. So much for the last few days of relative calm in markets.
Yeah, the calm's been broken.
It's been broken, and let's take a look at where things stand right now. The S&P 500 losing 2.8% as stocks decline with the U.S. dollar. They took a leg lower when the Powell headlines hit the tape, and we'll get to that in a moment here. But you really have semiconductor stocks leading the decline. The Philadelphia Semiconductor Index off by almost 6.5%. All 30 members are lower, led by NVIDIA, Advanced Micro Devices, as well as ASML on trade war concerns. You see yields moving down here with the 10-year yield off by almost 6 basis points at 4.27%. And as I mentioned, the dollar resumes its sell-off, got a respite yesterday, but now making fresh 6-month lows.
Yeah, that number at the top of your screen, really astonishing, Scarlett. If you look at the top 10 decliners on a percentage basis in the S&P, 7 of them are chip stocks. Remember, we came into this morning with U.S. stocks still mired in correction. And as you see this afternoon, they're sinking deeper into that muck. That once red-hot AI chip trade further cooling amid confusion about U.S. export restrictions for some of NVIDIA's chips and dour commentary out of chip equipment maker ASML. The Philadelphia Semiconductor Index still more than 30% below its most recent all-time high, and almost all of the members in that index sitting on double-digit percentage losses on a year-to-date basis alone. Meanwhile, over at the WTO, they actually slashed their global trade outlook from growth to contraction because of tariffs. It now expects the volume of world merchandise trade to decline by 0.2% this year, almost 3 percentage points lower than it would have been without the U.S. instigated trade war. And things could even be worse, a contraction of 1.5%. That's what the WTO says if the U.S. pushes ahead with those higher reciprocal tariffs. But don't look for any help from the Fed just yet. Cleveland Fed President Beth Hammack said there is good reason to hold interest rates at current levels until there's more clarity. And while Fed Chair Jay Powell in a speech also made a case for standing pat, he did acknowledge that a weakening economy and elevated inflation could eventually bring the central bank's dual mandate into conflict.
We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close.
All right, we go now to Bloomberg's Mike McKee, who is live at the Economic Club of Chicago event where Jay Powell had just finished speaking. And Mike, we saw that Jay Powell referenced famous Chicagoan Ferris Bueller when he said that life moves pretty fast. But then he added very quickly that the Fed is in no hurry to do very much when it comes to interest rates.
I think that's the takeaway, Scarlett. Basically, Jay Powell didn't say anything new today, but he reminded markets of what they're afraid of. The tariffs were bigger than expected, so inflation and unemployment will be higher than anticipated. The Fed doesn't know which one is going to go up first or how far. So the best thing for them to do right now is kind of sit and wait and try to determine what is happening with the economy as best they can. Nobody knows where the tariffs are going to come out. He said it's very hard to model, so we are just going to do our best to figure it out and wait until then because policy's in a good place right now.
But he did talk a little bit, Mike, about this idea sort of, okay, we're focused on the dual mandate. Obviously, you have the inflation side, the labor market side of it, and this idea that because of that uncertainty, they may now have to sort of address this idea that one is not going to be compatible with the other.
Yes, they are concerned a little bit about the stagflation issue. And for the first time, it's not really the first time he said it, but he emphasized it today. What they're planning on doing is they'll look at how far either one, unemployment or inflation, is from where they think it should be, and they'll attack the one that's farthest away, the one that will take longer to come back. But they're hoping they don't get there because obviously, as he put it, it would be a very difficult judgment to make.
Michael McKee out there in Chicago, of course, on the heels of a great interview a little bit earlier today. Professor JoAnne interviewing Fed Chair Jay Powell. And for the record, Scarlett, I would just like to point out, fun fact here, that Ferris Bueller was actually born in Germany.
Oh, so, really?
Yeah.
Ferris Bueller himself was born in Germany.
Yeah, I'm waiting for the copyrights to expire so I can write the ultimate fanfic of that movie.
But you, sir, are Mr. Chicago, right?
I am. He technically lived in the suburbs.
All right, so another famous Chicagoan.
He's a German-born guy, a fictional German-born guy. Kara Murphy is not fictional. She joins us right now. She's Chief Investment Officer over at Kestra Investment Management. And Kara, I mean, I don't know if you had a chance to actually hear what Jay Powell had to say today. And if you didn't, don't worry, because he said it before. And it raises this whole idea as to whether the market should even be looking to any sort of help from monetary policy anytime soon.
Yeah, I did listen to the comments, and I think the message that we should take from this is that the Fed is not coming to the rescue, right? Stagflation was sort of written all over Powell's comments, even though he didn't use that term specifically. He was clearly laying out a possible macroeconomic scenario where we saw higher inflation and slower growth. And what he said, or at least what I heard, is that we're going to take our time. We don't need to move today. And we're going to let these two things play out. There's a lot of weighing of both the magnitude and the duration of these impacts. And the Fed's not going to change policy anytime soon. So again, I think this idea that the Fed's going to come to the rescue and save us from this policy uncertainty, it's just not going to happen.
Well, then as an investor, though, I mean, how do you sort of position yourself? Because if you are of the belief that some of these policies are going to be economically damaging, and you're also of the belief that it's not going to be damaging enough for the Fed or anyone else to really ride to the rescue, where does that leave you as an investor?
Yeah, so the short answer is that you approach it very carefully. But what I will say is that we entered the year thinking mostly about two particular risks. One was that we had pretty high valuations in the market, especially in the Mag 7, super high concentrations in core indexes with those names. And you had, it was very clear from the beginning that we were going to have a lot of policy uncertainty heading into this Trump administration. Those two things together are what we're seeing today, right? It's not just the policy uncertainty, but you also had very high expectations for certain areas of the market. Those are the risks. The good side of all of this is what we're seeing is that the market is differentiating between some of those names where expectations were really high and then other areas that have really kind of been left behind and where expectations aren't so high. So bonds we've seen perform okay. We've seen value perform okay. Non-US has performed okay. And so all of that leads up to this idea that having diversification, having exposure to different types of asset classes is exactly what you need in order to get through this period of uncertainty.
It also helps that most of the turmoil seems to have subsided for now, that perhaps we've hit bottom, especially when you look at the knee-jerk reaction to Powell's comments today. You have stocks lower, the 10-year yield taking a leg down, showing prices are still up, and the dollar continuing to bump along its lows. How much of a relief is it to have that familiar risk-off dynamic take over as opposed to have everything decline, stocks, bonds, and the dollar, like we saw at the end of last week?
I think anytime you can see this sort of like range of outcomes start to be narrowed a little bit, it's good for the market, right? The market hates uncertainty more than anything. So we know we're not going back to this environment with no tariffs. We think that this environment with like extremely punitive tariffs against all of our trading partners is now also off the table. We've heard a little bit more about how the Fed is going to approach this, right? So every little piece of information you hope is narrowing that range of outcomes. So even though we're not to a point where we're really certain about what policy is, there's at least some of those tails off the table. And so I think every week that we go through here, we've seen a little bit of a narrowing of those outcomes, which should provide a floor for the market.
And speaking of narrowing of outcomes, I think about what United did yesterday, offering dual forecasts for its year ahead, one in what it expects and then another in a recessionary environment. To what extent do you think that that has created permission or a template for other companies to do the same? I mean, it provides transparency in a way that we weren't getting from companies.
I think that it's actually a very helpful approach because, again, you take off some of these extremely onerous scenarios. You're like, OK, even in a recessionary scenario, people stop flying as much as what we had expected. I can count on the idea that this is what the company is going to earn. So I think if a company can sort of like map out those different paths, it makes it much easier then for an investor like myself to be able to predict those different outcomes and to build a playbook for different macroeconomic environments. So I would think that we start to hear more CEOs take a lead from them and start to provide multiple different scenarios.
So as we get deeper into earnings season here, and I understand that for the CEOs, this is going to be a tough job, Kara, but do you need that ratification from them? I mean, we kind of already know that they can't forecast the future. Do you need to actually hear them articulate that?
I think for some of these companies that we expect to be most impacted by tariffs, where they have a little bit of certainty in terms of the range of outcomes, it can be really helpful. Not every company really needs to know this or provide this type of guidance. But for ones where, CEOs can see that, okay, yes, we can operate, we can be profitable in a very onerous tariff environment, it can only be helpful to be able to provide that to investors. And again, not everybody's going to do that, and not everybody really has to.
All right, Kara, always a great conversation. Kara Murphy, Chief Investment Officer over at Kestra Investment Management, kicking us off to the close here on this Wednesday afternoon with stocks right now hitting session lows on the day and gold right around session highs, breaching 3,300. A discussion on how this impacts the guys literally going after the gold. The CEO of Coeur Mining going to be joining us after the break. This is The Close on Bloomberg.
Gold setting yet another record today as it continues to outperform its cheaper peer silver. But Bloomberg Intelligence's Mike McClone thinks that this could be a worrying sign. Gold's steady outperformance versus silver, which began before the election of President Trump, could signal a turn for the global economy as the gold to silver ratio reaches the 100 milestone. Here with what this means for the guys who actually mine these metals is Michal Krebs, Chairman, President, and CEO of Coeur Mining, which operates several gold and silver mines across North and Central America. Michal, good to speak with you. And I want to start on a macro basis. When you take a look at the price of gold, which has given its recent run up, is now past $3,300 an ounce. What does that tell you about the state of the world, or what people think is the state of the world?
Yeah, well, thanks for having me, first of all. I never really thought I'd see gold above $3,000 an ounce. To me, what it says is the one word, and that's uncertainty. This really started in earnest back in 2022 when Russia invaded Ukraine. You really started to see central banks around the world start to diversify their reserve holdings away from the dollar. And gold has really caught a bid ever since then, and it's just gained momentum. Investors are now starting to join the party, I think, as they look at tariffs and the inflationary impacts potentially of that, just overall geopolitical uncertainty around the world. There's just risk everywhere, and people, in those times tend to turn to gold. So you have all of these things kind of lined up at the central bank level, at the investor level, and it's really leading to these seems like we're hitting a new high, all-time high in gold almost every day.
And of course, you mentioned tariffs. We know that the White House has exempted several metals, including gold and silver, from reciprocal tariffs. Yet it has also begun investigations that could lead to sectoral tariffs, for instance, on copper, which we expect is forthcoming. What is your confidence that gold will warrant a permanent exemption?
I think that will remain, just given the kind of reserve nature of gold globally. I mean, for us, we're a U.S.-centric company. The majority of our revenue comes from mines here in the U.S. Even in the case, we have two mines in Mexico, but everything we consume, that we purchase at our operations is really sourced locally. The metal that we produce in country is sold in that case in Mexico. So, we're pretty well insulated, but I think the exemption on gold will probably hold. Silver is a little bit of a toss-up because it's a little bit like gold, but it's a little bit like silver. There's about 70% of total demand every year for silver is industrial, mostly electronics. It's the best conductor of electricity in the world. So, it has some properties like copper. So, we'll see on the silver side, but we just ramped up a new silver operation out in Nevada that we just invested over $700 million to expand. So that becomes America's largest source of domestically produced and refined silver. So I think we're in a really good position given where we are on the global level right now. On
the issue of silver, though, I mean, given that a lot of times what people are buying silver for is different than what they're typically buying gold for. And obviously there's a little bit more cyclicality and economic exposure with regards to silver. Are you worried at all, given some of the concerns about a potential global economic slowdown?
Yeah, and I think we see that in the price of silver. Gold is at this point, more than 50% above its former all-time high, whereas silver is almost 50% still below its all-time high of close to $50 an ounce back in 2011. And I think a lot of that has to do with the fact that so much of silver demand is electronics, consumer electronics, smartphones, computers, chips, you name it. And I think that's probably been a little bit of a drag on the silver price. I mean, if silver does catch up, you mentioned earlier the ratio between silver and gold, typically that's more like 70 to 1. It's blown out, like you referenced, I think over 100 to 1. If silver does play catch up, there's still a long way for silver to go to hopefully knock out its all-time highs. But I think there is some headwinds on the silver side, given that demand profile.
I'm also curious just about general geopolitical risk. I know we talk a lot about what's going on in the context specifically of the tariffs that would have to be paid based on what's going in and out of the country. But like we take some of your operations in Mexico, so like the Palmarejo operations there, I know a lot of that, what comes out of that gets sold domestically into the Mexican market. But is there any concern that given the geopolitical tensions, assets like yours could become a political football?
I think that's definitely the case for places around the world. I mean, there are a lot of mining companies with a footprint, stretched around the globe in some places that I think are much more at the tip of the spear or the top of the list in terms of some of this, tariff uncertainty out there. I think in the case of Mexico, maybe less so, whether that's because of the USMCA footprint, over Canada and Mexico and the U.S., or just the fact that most of the silver that we require here in the U.S. Comes from Mexico. About 80% of what we need every year here in the U.S. comes from outside the U.S., and Mexico is at the top of that list.
You mentioned the mine that you have in northern Nevada for silver. You also own a polymeric silver zinc lead project in British Columbia, Canada. It's not in production, but it does give you some flexibility, some options. What would be the catalyst for you to switch on production there?
Yeah, well, we'll need a little bit more time to drill it and continue to expand it and put it through the studies that it needs to go through. And then there's some permitting. But I'm glad you brought up Silvertip because it's a poster child of these critical mineral deposits and projects that countries are now starting to really focus on. The world is waking up to how strategic these critical minerals really are and how, they're the building blocks really of our modern economy. And in the case of Silvertip, we have one of those sitting there. And I'd like to think that with some of the support now that we're seeing from governments like the one in Canada, like the one here in the U.S., that Silvertip now, especially at these elevated prices, could be moved along a bit faster and then become another North American source of production for us. In that case, it would be more silver, zinc, and lead. But for us, it's mostly about the silver. That would really take our overall silver production up into a pretty dominant place globally.
All right, Michal, got to leave it there. Great stuff. Michal Krebs, Chairman, President, and CEO over at Coeur Mining on a day where we see gold hitting record highs and silver at one point coming just a couple percentage points away from reclaiming its record high as well. When we come back, a refocus on what's going on in the equity space and a massive drop down today in the chip sector. NVIDIA dropping 10% on the day, worst day going back at least to early January. A conversation as to exactly what could potentially arrest the slide. That's coming up next on our top calls. This is Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with Target. Goldman Sachs actually downgrading the retailer to neutral, lowering the price target by more than $40 to $101. The Goldman noting that tariff uncertainty and inflation taking a toll on consumer sentiment, which will further delay a recovery in growth for discretionary sales categories. Those shares down about 2.5%. Next up, JP Morgan downgrading U.S. Steel to neutral, trimming the price target down to 38. The firm expecting U.S. Steel to take a hit as tariff uncertainty softens demand, especially in the auto sector. And finally, Lockheed Martin, an upgrade over at Morgan Stanley, with the analysts saying developments over the past few weeks point to an improving sector backdrop for the company. Those shares bucking the sell-off today, up about 1%, and those are some of your top calls. As far as that sell-off, a big part of the reason for that sell-off is NVIDIA. Biggest drag right now on all of the major indices, down 10%. So too is AMD. This after we learned that the Trump administration has released new restrictions on chip exports to China that prompted NVIDIA to warn about a potential write-down of $5.5 billion. Joining us right now is Matt Bryson, Managing Director and Equity Research Analyst covering the enterprise hardware sector over at Wedbush. All right, so Matt, when we saw the number, the $5.5 billion, and a lot of concerns here about what chips the company would be able to get out of the border over to China or whatever other customers want them, what type of impact are you modeling in right now for revenue at NVIDIA?
So I haven't shipped to my model yet, but they told us that China was low teens portion of revenue for AI last quarter. If anything, I think it may have grown a bit from there. China has been really strong on the back of DeepSeek. They've been taking more product. But you look at NVIDIA, you think roughly 10% of the revenue goes away. That's probably in the right ballpark, assuming this is how things stand from here on.
Is there any sense here, Matt, that NVIDIA could get a reprieve? Because it seemed like, again, over the weekend, that all the talk was about that dinner that Jensen Huang had at Mar-a-Lago and how, at least for now, he appeared to have been set.
I mean, this is the problem that over the last 3 weeks, everything's been dictated by policy changes, and it's very unclear where policy goes from here. Is this a trading chip that the U.S. is using to try to get concessions from China? Is it more about longer-term security? I would argue that the H20 is more of an inference product, so it's really going to be used less for developing technology that's potentially harmful to the U.S. And more for running applications, but it's just really hard to tell.
Assuming these are permanent export controls, what happens to the supply of H20 chips that NVIDIA is no longer able to sell? Is there still a market for this chip that is powerful but not too powerful?
That's the problem, is that there isn't a market. So this chip had been restricted for China use only because China couldn't take the more powerful chips. If I'm in any other geography, I can buy an H100 or an H200 or a B100, all of which are more powerful than H20. So this product effectively has no market.
Okay, so Matt, just walk us through quickly what this will mean when TSMC reports results. So
TSM, last time we were in a situation like this where there were a lot of unknowns with COVID, and TSM only guided down a few percentage points from their prior guide. I wouldn't be surprised if TSM ends up in the same situation this time, or even still gives us a 2025 as flat. Last time I talked to them, they reiterated what they said on their earnings call, which is there's not enough high-end semiconductor production, and that may still be the case.
All right, Matt Bryson, really appreciate your joining us, Managing Director and Equity Research Analyst over at Wedbush. Coming up, we'll speak with Michal, Katz, Head of Investment and Corporate Banking at Mizuho Americas on M&A ahead. This is The Close.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. And, relatively quiet day, even with equities lower. But one thing that we've been talking a lot about is how there hasn't been a whole lot of M&A. And there was a deal today, although it's fairly small. Lyft buying a European taxi hailing app for almost $200 million from BMW and Mercedes-Benz Mobility.
I guess a deal is a deal, right?
It is.
But it raises the question, too. I mean, we haven't seen, obviously, a lot of deal-making activity, particularly given some of the expectations coming into this year and coming into this administration. But there are people sort of sniffing around for bargains. I'm not sure what the origin of the Lyft deal was, but you saw the story on KKR. I mean, they did $8 billion in deals just last week alone. So there are bargains out there, I guess, if you have the cash and you're ready to go.
And, I guess this is as good a day as any in terms of the stable market conditions because you have a regular kind of risk-off environment right now. So for more on the M&A space, we want to bring in Michal Katz. She is Head of Investment and Corporate Banking at Mizuho Americas for her outlook. And Michal, it's no secret that M&A has been slow to come in 2025. Just give us a sense from where you sit, how you would characterize the activity that is taking place. What kind of conversations are companies having right now?
Well, thanks so much for having me. And I'd say that coming into 2025, expectations were high that the pro-growth pro-business administration would actually catalyze both capital markets and deal-making activity in M&A. And clearly, some of the uncertainty that we've seen has shaken that confidence, which very much underpins what deal-making is. But I'll make a couple of observations as we think about the broader landscape. M&A at its core requires an industrial logic to support a transaction. Many of the investments, whether it be CapEx on an M&A deal-making, are ones that require multi-year investments. And so there are some deals that have been getting announced. They also have been in the works. But I would say is that without that confidence underpinning I would say conviction, it would be hard to get deal-making activity coming in back at the anticipated pace. I would say the following. When you take a look at the first quarter of this year, U.S. M&A has been down, but international M&A was actually up, driven by activity in both Asia and Europe. I'll just note two of those with the CK Hutchinson transaction, which they sold ports, including the Panama Canal, to a BlackRock consortia.
Although Beijing wants that reviewed.
100%. As well as Google acquiring Israeli-founded Wiz in the cybersecurity space for $32 billion.
So that's a really good point. I guess what I'm curious about, too, is given the results we heard from the big banks, they were fairly sanguine about their outlook. And it's clear that they're still willing to lend money at a time when a lot of PE firms need to put money to work and also return capital to their LPs. Do you think deal structurers will get more creative as a result of this?
Well, some of the transactions, you mentioned a couple in the market, have seen cash transactions, but I do think we need to take a step back. I do know that our U.S. economist, Steve Ricciuto, was on this morning as well. And coming into the 2025, I would tell you the economy has continued to be on solid footing, whether you look at GDP growth, employment, the balance sheets of the household, the banks, corporates. I understand that hard data tends to be a lagging indicator, and sentiment has definitely shifted to the downside. But those, to me, inform the fact that our economy can sustain shocks coming out of a slowdown of sorts. The other thing that I would say, when an organization is looking towards M&A or capital investment, they're looking to future-proof the business. Now, you asked about financing. I'm proud to say that Mizuho reopened the high-yield market yesterday with an upsized transaction for Venture Global, $2.5 billion in the marketplace. We also advised Lowe's on an acquisition yesterday. And so the banks, you saw in earnings, trading have done well. Deal making has been negatively impacted by the volatility. But on balance, I do think that once we get some stabilization into the system, it should unleash some of what I would call the, this bottleneck that we've had. We don't need perfection, I always say, but we do need some stability. And hopefully this should set us up for a better second half. Although I'll caveat it by saying, don't expect 2025 to be setting any records for deal making.
Okay, so at least not at the top, but as far as the bottom and the worst case scenarios that everybody had predicting, you're not in that camp as well. I mean, you've lived through or worked through several crises, including being at Lehman during the global financial crisis and the dot-com bubble bursting. This isn't that, is it, when we talk about the impact on deal volumes?
That is not our case. I mean, but you mentioned earlier on, like, what are CEOs, what are boards doing? They are planning for multiple scenarios just to deal with that wider distribution of outcomes. And to me, the United earnings that came out, giving you a base case and a bear case, is indicative of that. But no, we're not predicting, nor are we factoring in any type of that shock in the system.
I am curious about just geographically where the money is flowing. You mentioned that you are seeing a little bit more deal activity in Europe relative to the U.S. I know you guys have been doing a lot with Green Hill, an acquisition you made, and that you've been trying to tweak along the edges. But this was, I guess, an appeal to the European investor. Is that business that you're seeing through Green Hill, is that primarily going to stay in Europe, or are you also seeing more cross-border activity here with the U.S.?
So Green Hill had presence both in EMEA, the Americas, as well as Asia-Pac, including Australia. And a lot of the activity that we are seeing is cross-border. And let's not forget Mizuho is a Japanese bank. And as you know, Japan has been going through this economic revitalization. And we're seeing a lot of interest going into Japan, as well as Japanese companies looking elsewhere, whether it be the U.S. Steel, Nippon Steel as an example. And it's not just corporates, it's also private equity. And so you're asking whether it's internally. I would tell you that cross-border is really happening across the board.
Okay, so there's geography, and I also want to ask about sectors. What's your read on regulation on deals within big tech? We've seen that the FCT appears to be as strident as it was under Lina Khan, especially when it comes to certain kinds of deals. Meta, for instance, there's a trial taking place right now. Do you think that extends through the Trump administration?
So that's a great point. You know, one of the I would say surprises in February was when the new FTC chair, Andrew Ferguson, decided to uphold the merger guidelines, which many thought would be rescinded outright or amended. But when you speak to the legal community, the view is that the application or the enforcement of the guidelines would be more reasonable. So they would be more willing to negotiate remedies with counterparties as opposed to try to go and litigate in order to establish new case law. You asked about tech. I think that the expectation that we have all had that tech would continue to be at the crosshair, but it wasn't kind of raise some eyebrows that they had decided to block the HP transaction. You talked about Meta. You saw today the news around NVIDIA and the H20 Blackwell chip. So I don't think that tech will be immune.
I'm going to ask you a somewhat loaded question, but I do have to ask. I mean, you mentioned obviously Mizuho being a big Japanese bank. It made huge inroads into the United States, partly because of you. You've made huge inroads into Europe. We're now at a moment in time where everyone's questioning globalization and the interconnectedness of all of these different regions. Is this going to end up being potentially a mistake, that expansion?
First of all, it is because of the team that I've built that we have made such great inroads. So thanks for bringing that up. Look, the underlying decision behind Greenhill was to broaden our M&A capabilities. M&A, if you look at Q1 of this year, constituted 45% of the investment banking fee pools. On average, it's around 40%. For us, it was leaning in toward an area where we were underweight. Secondly, Greenhill has great capabilities advising public companies, very much aligned with Mizuho being a corporate and investment bank, and so better able to serve our clients. In terms of globalization, it's going to be incredibly hard to completely unravel 40 years of what I call the post-World War II economic order, but it is getting reshaped. And so we're seeing Japan in with the administration today and other countries coming in to try to come up with some sort of a solution or some sort of a compromise. And so, no, I have full conviction behind that acquisition.
All right. That's a great place to leave it. Appreciate your candor. Michal, Katz, head of investment and corporate banking over at Mizuho Americas. When we come back, a closer look at one of the biggest gainers of the day. It's our stock of the hour, and it's up next. This is Bloomberg. Fewer than 50 of the S&P 500 stocks in the green today, and one of them is Abbott Labs. The company shares rising after an earnings report met analyst expectations despite the threat of tariffs. Billy Lipschultz joins us right now, helps to lead our equities coverage here. An interesting pop on the day, 3% on a day where everything else is down. Is this all about the numbers from the most recent quarter?
It's partly about the numbers, but it's also the broader dynamics of if we are dealing with uncertainty in the markets and people are dumping technology stocks, well, healthcare at least should be better positioned. We had at least one analyst coming out saying it could be kind of a port of calm in the storm. As it is, just given the volatility, and broadly speaking, if you make devices, say, for people who are monitoring their diabetes, they're not going to turn that off. So there still is demand. And also the fact that they maintain guidance for the full year, despite a rocky first quarter and despite these headwinds, even this company CEO basically.
And we should point out, Abbott gets most of their, or the biggest bulk of their revenue comes from medical devices.
Medical devices is the main driver. They have nutrition, so they make Ensure and things like that, but that's really the big driver for them.
Have you had Similac lately? No.
The other thing that Abbott is doing that we've seen from a lot of companies is talk about how they're going to invest in U.S. manufacturing, $500 million in this case. Is this a new investment? Do we know?
It seems like it's going to be part of kind of more that broader nearshoring trend. They did call out in their release that they do have kind of a diverse supply chain, so they are dealing with those kind of ramifications. But again, CEO did say a few $100 million in terms of the impact of tariffs. So when you're trying to invest and alleviate some of those headaches, the one thing that was interesting, though, that stood out to me from the earnings call was that the CEO is basically like, we still are dealing with the costs from the 2017 kind of things that the government put in place. So these aren't headaches that go away. They're not transitory. So there are things that actually impact the bottom line of the business. So I do think that's part of how they're trying to navigate the path forward.
We only have about a minute left, but I am just curious more broadly about where people are looking for safety in this market. Obviously, traditionally, healthcare has been one of those areas, the idea that it's recession-proof because you're going to, get your medical procedures done, whether bad times are good or bad. But when I look what's up today, there's not a whole lot else. I mean, gold stocks and defense contractors.
Exactly. And I think the broad thing, though, Romaine, is we're still dealing with an uncertain health environment with Robert F. Kennedy Jr. leading the FDA. So you're dealing with those headwinds. So medical devices are more of a safe bet as opposed to biotech, which I just had lunch today, where it's like no one wants to go anywhere near that. And even the specialists are on edge.
I got 3 vaccine shots this weekend.
Really?
Yeah, I got like the old man vaccines, like shingles, tetanus. What was the other? Oh, pneumococcal, which I didn't even know was a thing. And I said, why do I need these? He's like, well, sir. Sit down, old man. Anyway, Bailey Lipschultz, the youth of Bloomberg television there. Scarlett.
All right, we're going to take you to the closing bell. We've got about 15 minutes left to go before this market closes. JoAnne Feeney, partner and portfolio manager of Advisors Capital Management, will be joining us next. This is The Close on Bloomberg.
For some of these companies that we expect to be most impacted by tariffs, where they have a little bit of certainty in terms of the range of outcomes, it can be really helpful. Not every company really needs to know this or provide this type of guidance, but for ones where, CEOs can see that, okay, yes, we can operate, we can be profitable in a very onerous tariff environment, it can only be helpful to be able to provide that to investors.
Kara Murphy over at Kestra Investment Management, kicking us off to the close just about 50 minutes ago, Scarlett Fu. And unfortunately, the situation in the market appears to be deteriorating. We're off the lows of the day, but still a phenomenal break from that relative calm that we had the last couple of sessions.
Down, down, down for the equity indexes, certainly after Jay Powell spoke and those headlines on how the Fed is in no rush. And you really see the pain in the chip maker space. All 30 members are down, led by NVIDIA, AMD, and ASML on trade war concerns. And of course, I included energy stocks only because they're the outliers. They're the lone holdouts in today's sell-off. But again, these are the biggest decliners since April 2nd, still down about 15% since Trump announced those reciprocal tariffs. And the VIX inching up again, but you can see that it is holding in the low 30s.
Yeah, absolutely. I mean, I was going through that list of kind of the big gainers on the day in the S&P 500. And a lot of energy and mining and materials names in that a lot. And in fact, when you take a look at the broader market here, it's certainly a bid to a certain extent to safety. JoAnne Feeney joins us right now, partner and portfolio manager at Advisors Capital Management. And JoAnne, I was kind of going through kind of what the winners are today and really over the last couple of weeks. It's basically low volatility stocks, whether it's on a pure factor basis, on a long short basis. That's a winning trade today. It was a winning trade over the past month, and year to date, that's been the winning trade as well. Is that where investors should really kind of focus on low vol value? Is that it?
Yeah, it really depends, Romaine, on their time horizon. The longer term investor wants to make sure still to have exposure to those kinds of companies that are going to participate in what we're calling, the new economy growth engine, which is still artificial intelligence. And so even though it's obviously a very rocky ride, this separation of the U.S. and China and the protection the U.S. wants to create for our AI leadership is obviously causing a lot of headaches. But that doesn't mean that these stocks still don't offer really good opportunities for growth for the multiple years out from now. And that's what long-term investors really need to keep in mind. Other investors have a shorter-term focus and need to do more to protect their principal. And in those cases, right, they want to go to the sort of stocks that are more like consumer staples, utilities, less volatile opportunities.
For those longer-term investors who are looking at those broader structural themes and changes, and AI is obviously at the center of that. AI, of course, also being scrutinized a lot more, particularly in light of some of the export controls, if you will, as well as just a broader concern about a drop or a pullback in some of that CapEx spending. That doesn't worry you at all over the long term?
Well, there's a lot of concern certainly about how much more CapEx spending will be coming to power the build out of the AI infrastructure. There's no question about that. But right now, we're not seeing any real cracks in that spending. Microsoft may be moving their situation a little bit on where to build data centers and with whom to partner, and their partnerships are changing, and that's causing some of their CapEx plans to change. But overall, when you look at the data, the numbers that are still out there on total CapEx spending for AI infrastructure are still growing very nicely and look like they're going to do so for many years to come. So, yeah, longer term, I think that's still a very good opportunity.
And of course, we'll wait to see what these companies say when they do announce results in the coming weeks. Speaking of CapEx, I'm wondering when companies like Abbott say they're going to invest $500 million in 2 U.S. facilities to nearshore or reshore some of their manufacturing. It's a move that pays off politically, they hope. But is it a move that changes the attractiveness of the stock, of the company's fundamentals for investors?
From what I've seen so far in their operational costs, it doesn't look like it'll be that much more expensive for them to shift some manufacturing to the U.S. out of Europe. And so, overall, the company's attractiveness isn't really affected that much. The problem, right, for them and the administration in trying to incentivize companies to move some manufacturing here is that it will take years. And so, we hope that these sorts of announcements from companies like Abbott will forestall any move by this administration to put any significant tariffs on the import of pharmaceuticals. Those brand name pharmaceutical companies will be just fine if they end up moving here. It's the generics that really are it's uneconomical for them to try to move manufacturing to the U.S. So that's a big question as to what happens to that side of the industry, and we're not excited about those sorts of stocks.
As a result of that, because of that reason?
That and others, but yeah, that's a pretty big reason. First of all, their margins are really thin, so it's a very tough business to keep operating well, and that makes it a very challenging place to invest. But when you have a headwind like this potentially, that could destroy the business, that it could actually make it uneconomical to even sell into the U.S. if there are any material tariffs, that obviously creates an awful lot of risk.
A lot of risk, and it raises the question, too, about the global exposure that a lot of companies in the S&P 500 have. Do you need to start, as you're picking stocks for the long term, do you start to parse through some of those names?
Yeah, what we've done since the beginning of the year, Romaine, since we started to see this kind of a risk increase, was we did shift a little bit within our balance strategy, which is our most conservative approach for investors. And we like the volatility there to be less than the market as a whole. We did start to shift towards companies that have more domestic exposure. And we've continued to make some trades in that direction over the last few months. Owning a company like United Healthcare, for example, and decreasing our ownership of companies that have more exposure to the higher input costs that those tariffs will create. That's one way of trying to shift away from this kind of risk. And so, yeah, we've definitely taken steps in that direction.
All right, JoAnne, got to leave it there. JoAnne Feeney, partner portfolio manager over at Advisors Capital Management, counting us down to the closing bells. Those bells just about 3 minutes away, Scarlett, and we were talking about how not a lot's moving in the S&P 500, but there is one stock. It's not in the S&P 500, but it's having a phenomenal day. This is shares of Hertz. Remember, they got a bid earlier in the day, largely on the disclosure that Pershing Square had taken a stake in it. For some reason or another now, they've shot up another 20 percentage plus points, all the way up now to a gain of roughly about 54% here on the day. Is meme stocking, is that back?
I feel like this is the new meme stock. I mean, it kind of was as well earlier, but definitely not clear on what's driving this because the Pershing Square news was on for a while now, right?
Yeah, so and we should point out, no headlines on this, so we'll, of course, keep an eye on any news to bring it to you, but really just kind of indicative, too, of this idea that there are people out there still willing to speculate, still willing to bet whether Hertz should be that bet. I mean, that's a whole other debate.
Absolutely. I mean, there's also the argument that that Hertz and Avis will benefit from the various tariffs and uncertainty because people want to be buying used cars and they have a lot of used cars to sell off.
All right. Across asset classes today here, the VIX elevated right around 33 at the moment. Yields down across the board, primarily on the shorter end of the curve, 7 to 8 basis points for your 2-year and your 5-year lower. The dollar having an awful day, and so too are stocks. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Scarlet Fu, taking you through that closing bell. It's a global simulcast. It starts right now with Carol Massar in the radio booth. Tim Stenovic, who she allowed to share space with her today, as we welcome our audiences across all of our Bloomberg platforms. On a decidedly interesting day, we were talking the last couple of sessions,
kind
Carol
of a nice
Massar.
person on most days.
Most days.
Yeah.
I don't know.
Not every day.
Not on odd number days. But when we talk about this idea of the calm that has swept through this market, and a calm being broken today, though volumes are light, but stocks down significantly.
Yeah, and I guess Tim keeps beating me up here because I'm like, but Tim, look, we're seeing actually some buying in the last few minutes of the session. And you know what? Just when you think maybe 2.2% lower on the S&P is kind of a bummer, check out the SOX. It's down 4% today.
Yeah, it was down worse earlier.
It's
off its worst levels of the day.
7%.
But look, if we talk about crucial moments of the day, I think it's none other than hearing from Jay Powell a little earlier, and specifically the concern that he has about what the Fed would do in a stagflationary environment, but also that the tariffs, as they were rolled out, were bigger than expected, which means they could have a bigger effect than expected.
I feel like they need to do what United did and give two different forecasts.
Exactly.
The base forecast and then the bearish case.
Yeah, I mean, the problem, though, is it's so confusing, right? We talk about this idea that a few days ago we were talking about this exemption that NVIDIA likely had with regards to those H20 chips. And then basically it's not an exemption. And then we get effectively a warning that they're going to write off $5.5 billion on this. I don't even know what you can even put out there with confidence.
Yeah, well, welcome to our world. Uncertainty. Hashtag.
Well, we get the closing bells here in New York, and it is red across the screen. An S&P 500 lower by more than 100 points. Looks like it's going to be a drop of roughly about 2.2%. And we were much lower than that on the day, but nevertheless a close below that key 5,300 level. The Dow Jones Industrial Average dropping about 700 points or 1.7%. The NASDAQ indices, of course, that is your biggest drag here, largely because of the weight that we saw from NVIDIA and the rest of the chip stocks. The NASDAQ Composite and NASDAQ 100 each down about 3%. And the Russell 2000, that's your relative outperformer, lower by 1% on the day.
All right, quick check on the S&P 500, and we're going to get a little bit more on this, but pretty broad-based in terms of the selling. Scarlett, we had 436 names to the downside, 66 to the upside, 1 unchanged.
All right, let's take a look at the IMAP. It should be pretty straightforward here. A lot of red, and most of it dominated by big tech sectors. Tech and consumer discretionary and communication services all down by at least 2.5%. The outlier here is that thin slice in the upper left-hand corner. That is energy stocks gaining 0.8%. By the way, they are the worst performers since April 2nd, still down about 15%, but they are moving higher with oil prices.
All right, guys, guess what stock I am glued to as we speak?
Your gainers today?
Yeah, it's a huge gainer.
Hertz?
I'll give you a guess. It's on the screen right now. That's the hint.
I just keep watching it. It's up about 52.
Man, I had a 1 in 3 chance getting it right.
Well, hey guys. All right. So Hertz is up 56%. We saw some big movement to the upside in the last 20 minutes or so, 15 minutes. Unbelievable.
Why?
Why? Well, we know the backstory because it's been higher all day today. But we did see Pershing Square Capital Management revealing a large stake in the company. It's had its woes big time, no doubt about it. Bill Ackman's firm buying 12.7 million shares, valued about $46.5 million at the time of the purchase. That was a filing today, making it one of Hertz's largest shareholders. So we know they've been working on revamping their fleet, doing a lot of things. Looks like Bill Ackman wants some changes as well. So I don't know. I'm just kind of glued, waiting for maybe a headline to cross. But we're just going to have to wait.
The volume is amazing here, 58 million shares, and on average, it trades about 7.8 million a day.
Yeah, so a lot of activity, right? Just seeing it in a big way. All right, another gainer, Abbott Laboratories. Should we go to earnings, or do you want me to continue?
I'll just pick up here. We are getting earnings out of CSX, of course, the big railroad operator. On EPS for the most recent quarter, it did look like a miss. 34 cents a share. The street, on average, was looking for 37 cents a share. Revenue also coming in a bit light, $3.42 billion. The street was looking for 3.46. I need a little more time to dig in to see if there's any real commentary here on tariffs, as well, of course, as some of the issues with regards to economic conditions. But the share is lower by 5% in the after-hours trade.
I will say the President and Chief Executive Officer, Joe Hinrichs, saying CSX faced operational challenges to start the year, which contributed to first quarter results that did not meet our expectations. So a little bit of commentary there.
So macro, not, or micro, not macro. Like these are unique to this company. So operational, not negative on the economy.
Which will be interesting to see what they have to say, though, maybe about the economy. Still, though, CSX down, bouncing around here, unchanged, but we did see initially a big drop here. All right, I'm going to go back to gainers, if I may. Abbott Laboratories, folks, up more than 6% at its highs, finishing the day with about a 2.7% gain. CEO Robert Ford saying during their earnings call that the company expects a 2025 tariff impact of about a few $100 million. So I guess investors were like, maybe they can deal with that. Companies also making some new investments in U.S. manufacturing here in the United States with the impact of tariffs on medical devices and diagnostics looming over the industry. So they're going to spend about $500 million on two facilities located in Illinois and Texas. I should say with earnings, they reaffirmed its annual guidance and reported adjusted EPS that were in line with Wall Street estimates. And then here's a smaller market cap company. It's a grocery company, $1.4 billion market cap. It's based in California. We're talking about Grocery Outlet Holding. It was up 5.3% at its highs, up almost 11% today, but still closing with a 5% gain. Being raised to buy from hold at Jefferies, which says the company's defensive positioning as a low-price grocer could fuel outperformance amid economic uncertainty. So there's the U word.
Okay. I just want to just real quickly go back to Hertz, because a viewer actually wrote in. He was saying to look at the short interest. I didn't realize how many short shares.
Crazy.
Yeah, it was
like 45% or something like that?
Yeah, 48% based on Bloomberg calculations. And that was as of yesterday, coming into today's session.
So this is a violent short covering rally then?
Potentially, yeah.
Yeah.
All right, certain outlier today in today's trade. I want to go to NVIDIA, the one that really started things off on the downside today after we got that news late yesterday that the Trump administration has restricted the company from selling those H20 chips in China. It'll cost the company billions of dollars and affect its product line, down 6.9% in today's trade. At one point, it was down as much as 10.5%, but it came off of those lows. The restriction will impact NVIDIA's revenue with estimated write-downs of $5.5 billion. It could affect other chip makers, too, which is why we saw AMD fall today. Samsung and SK Hynix could be affected as well. And staying with the semiconductor space, I want to look at ADRs of ASML because this is actually a tariff story, not a restriction story. Those shares fell 7% today after the company reported first quarter orders that were almost €1 billion less than expected and warned it doesn't know how to quantify the impact of recent tariff announcements that has threatened to upend the semiconductor industry. The company outlined potential risks from U.S. tariffs, including additional charges on shipments, and said it has no plans to move production to the U.S., but it may pass on some tariff costs to customers. And finally, the company that reported after the bell yesterday, J.B. Hunt shares falling 7.7%. The company reported revenue in multiple segments that fell short of consensus estimates. It did beat expectations when it came to intermodal, and first quarter profit came in above estimates. Analysts, though, pointed to continued concerns about the impact of tariffs and, of course, the broader economy. We saw price targets cut at least 3 firms that followed the stock.
All right, let's take a quick look at yields because the volatility there did continue here. Although we did see a little bit of a flip-flop from what we had seen a little bit last week, this time a drop in yields of about 7 basis points on that most rate-sensitive, Fed-sensitive part of the curve on that 2-year, down about 7 basis points. On the longer end of the curve, you're only looking at a drop of about 3 basis points. But look at those absolute numbers here, 3.7, 3.9, 4.2, 4.7, and that gives you a sense here as to why some folks are in the other asset classes are being rattled.
Yeah, although there must be a relief among market participants that at least we're going back to a traditional risk-off dynamic where stocks are down, the dollar's down, but bonds are higher, pushing yields lower, right? Because for the last couple of days, we had seen this odd and concerning situation where everything was going down at the same time.
I thought about that exactly. I mean, it's kind of crazy, right, with all this uncertainty out there, but to see that it's kind of normal in terms of the way the markets are supposed to work, because when it doesn't, it really raises some questions about what is truly going on here. But I keep thinking, I just want to get more earnings and see what companies have to say and see if anything's holding up. Or
so does that mean Netflix, it all rides on Netflix tomorrow after the bell? Is that the true test? Are consumers pulling back on Netflix? Are more people going to the cheaper tier option where advertising is offered?
Yeah.
What's the concern?
Well, I mean, the only problem with Netflix is that going to be as much of a barometer, a broad economic barometer? I mean, I feel like it's such an outlier. We can remember tomorrow we get, some healthcare names like United Health and I think a few other banks, regional banks, as well as D.R. Horton and some others. So maybe that'll be a better representation of where economic conditions are at. Because I don't know about you, but I don't even know what the heck I pay for Netflix anymore. It just gets charged to my credit card.
It's a utility, essentially, for a lot of people.
They could be charging me $50 a month.
You have people who take care of that for you, right?
No. I do everything myself.
No, but I agree. Listen, the more the merrier is how I'm kind of feeling, because I just think we want to hear what these guys have to say, what kind of visibility they have. Do they do what UAL did? And
you know what I did? I actually got rid of 2 of my subscription services.
Which ones?
Which ones? Yeah.
Am I allowed to say on air?
I got rid of Prime. I said it's okay.
I got rid of Prime.
Okay. Also, no more free shipping for you.
Yeah. Well, that wasn't much of an issue for me. But and then we never watched the Apple one. We watched Severance on that, or what was it? Not Severance. Severance. Yeah, that was it.
Or you know what? You'll just flick it back on when the new show comes on. That's what everyone does.
I thought he got rid of Brav.
Or maybe Scarlett can share her memberships.
You're not watching
she's got them all.
anymore,
Apple.
right?
I do. This is
Costco.
an investment for me.
Just Romaine, I'll order all your stuff to be delivered to me, and I'll bring it to you. Okay?
Thank you, Tim.
You got it.
Yeah, Scarlett's fancy. She just tries to downplay it.
Are you done?
No.
All right, we got a wrap. All right, guys, it is a wrap on this Wednesday. Our cross-platform, radio, TV, YouTube, Bloomberg Originals. We have fun. We get through it. We will see you again, same time, same place tomorrow.
And the conversations continue right here on Bloomberg Television. A closer look at market conditions, a closer look at economic conditions, and a closer look at how the uncertainty is reshaping the way private equity firms approach deals. Jeff Aronson, co-founder and managing principal over at Centerbridge, he's on deck. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. And unlike the last couple of days where we saw volatility really low, the market moved in a much different direction than what we saw on
Turbulence
Monday.
Is back.
Absolutely. And of course, the unchanged conditions yesterday, down 2.2% on the S&P 500 today, back below that 5,300 level. And a lot of questions really being asked right now, not so much about corporate fundamentals, about the economic uncertainty and how that's really just created a certain level of paralysis. Paralysis amongst consumers, paralysis amongst businesses, and now to a certain extent, paralysis amongst investors. So what worked and what didn't work today? Well, if you were in the metals, mining, material space, you actually maybe had a good day. Spot gold rising above that 3,300 level, continuing to charge towards fresh record highs. In the metals and mining space, we saw a lot of activity, particularly with some of the names in the critical mineral space. And then, of course, what didn't work, Scarlett, was what had been working the last couple of years, and that was chip stocks and AI.
And the granddaddy of them all is NVIDIA, down almost 7% on the day, the worst performer in the S&P 500 and the NASDAQ 100. The company saying the White House's decision to ban sales of its H20 chips to China will cost it about $5.5 billion. That write-down will show up in this quarter's results, which will be released in late May. So there's a net effect on that company stock. MP Materials up 10%. Romaine mentioned critical minerals miners getting a boost today. This is one of them. This is after Donald Trump launched a probe into the need for tariffs for this sector on these commodities. So if the investigation finds that these imports impair U.S. national security, then these tariffs would take the place of the reciprocal tariffs that were announced and, of course, then paused for 90 days. So that's good for a 10% increase. Now, our top story this hour is stocks taking a big leg lower following Fed Chair Jay Powell's warning that trade tensions may undermine the central bank's dual mandate of full employment and stability. The central bank head also once again signaled that he is in no hurry to act, even as he expects volatility to increase. Take a listen.
Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored. We will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close.
The Fed chair speaking earlier at the Economic Club of Chicago. Meanwhile, back here in Studio 2 in New York, Jeff Aronson joins us. He's managing principal and co-founder over at Centerbridge Partners. And I'm not sure, Jeff, if you had a chance to listen to the entirety of what Jay Powell had to say today. He kind of said the same thing before. And it's sort of a sense of paralysis also at the Fed, this idea that for right now, they don't really see much of a reason to do anything. And I do wonder in your world, when it comes to finding new deals, as well as just managing your current deals, whether you're maybe feeling a similar sense of paralysis, or at least stasis.
I think it's easy to be paralyzed in this environment. I think even in his prepared remarks, I believe he said we're waiting for more clarity before we do anything. I think that feeling is rampant, not just in the investor community, but in the business community. Imagine you're a CEO of a middle market business in the United States, and you're debating whether you should buy a competitor or build a new plant. In light of everything happening, I think it's more likely than not, I'm going to pause. I'm going to wait. And the same thing with the consumer. Is the consumer going to go out and buy a new car right now? Okay. I'm not sure. You want to wait. And I think it's the same thing with investors. It's easy to wait. I don't think that's necessarily the right answer, but it's easy to wait.
With some of those companies, are we looking at a situation where those companies have the luxury of sitting this out, the idea that maybe they don't need to come and look for a deal, look to raise money? Or is this sort of that cliff where some of them have no choice but to find new sources of funding and new opportunities and are going to have to weather this market?
I think because there is so much uncertainty, which is certainly the word of the day, the word of the week, actually, it would be unwise if you're a manager not to be thinking about the fact that, do I have adequate liquidity to run my business over the next period of time? And if you don't, you're thinking hard. I better get it now. I better get it quickly because I don't know what tomorrow's going to bring. It's a tough environment, I think, to manage a business these days.
So you oversee your firm's investment activities. You're particularly active in alternative investments. So we're talking private equity, private credit, real estate. Of those three buckets, which part of the business feels like they can move ahead with what they can control, the parts that they feel they have some visibility over?
I think the fact that we're a private investor really gives us a leg up. So in this type of environment, again, whether you're looking at a private equity transaction or a private credit, a new loan, or a real estate deal, I think you have to look for three things. One, you have to look for a very high quality, either business or asset to invest in, whether purchase or lend to. Second, the price has to be right. Price has to be right. The leverage has to be modest. And then the third thing, as I think about our entire business, the fact that we're a principal, the fact that we're at the table, at the negotiating table, having a hand in our own destiny, I think is a huge advantage because we can actually influence the outcome by growing a business, by helping it improve its operations and things like that, as opposed to a passive investor where you're kind of sitting in the back. You don't know what's going to happen exactly.
Let's go to that point that you made about the price has to be right. Is the counterparty seeing things in the same way, or do they need to be convinced?
I think in this type of environment, people are probably less likely to transact or not, because oftentimes, let's say you're a seller of a business. You want to sell at last year's price, or the price 3 months ago. You don't want to sell today. And the buyer or the investor wants to buy at the new price. So what happens? You get this gap. And sometimes during those periods, transaction activity slows down. That's what we're seeing right now. But there are always a group of companies and there are a group of investors that are willing to transact even in the face of uncertainty.
I am curious with your existing portfolio. I mean, how much exposure do you have right now to the consumer, so to speak, the consumer spending and any sort of changes in that spending?
If I think about direct exposure, we don't have, for example, we have no retail exposure. So I think about it more in terms of the impact. If there are going to be a series of tariffs in this country, what's the impact on our portfolio companies? And we've looked at each one of our businesses and tried to determine that. And at least for us, that first order level of impact is quite low. But the second order of impact, so for example, I don't know what's going to happen if there is a global trade war. That's going to impact the entire economy, likely recession. That will impact all businesses. So we think about it at two levels. First order, pretty muted. Second order, hard to know at this point.
What's the situation with real estate? I've heard from a lot of investors, at least on the commercial side, that they're actually finding some pretty good deals. And to Scarlett's point, much more alignment in terms of how they're valuing things and how the existing owners are valuing things.
That comes down to price.
Yeah.
Because what has happened over time, markets will find the right level. And for a number of years, the real estate market, in terms of number of transactions, it's been really slow. And what's happening now? It's starting to unfreeze. And that's what always happens with markets. In time, the right price comes to the fore.
All right. Thank you so much, Jeff Aronson, managing principal and co-founder at Centerbridge Partners, for a look at what's happening in the private equity and private credit, as well as real estate worlds. We do have some breaking news because Alcoa has just reported results. And for the first quarter, sales missed analyst estimates, while adjusted EBITDA and adjusted EPS did top analyst consensus. In terms of the outlook, Alcoa still sees its full year aluminum shipments at 2.6 to 2.8 million metric tons, and it still sees full year aluminum productions at 2.3 to 2.5 million tons. It does see a second quarter negative impact from tariffs on aluminum from Canada. Nevertheless, that stock is up 1.9% right now in after-hours trade. All right, coming up, we are going to further break down today's sell-off. You saw the big leg lower after Jay Powell spoke with Jonathan Levin of Bloomberg Opinion. This is The Close on Bloomberg. All right, we're taking a look at what happened in trading today. What started off as a fairly orderly decline really took a leg lower at midday when Jay Powell began speaking and made clear that the Fed is not going to ride to the rescue of increased volatility, because they are, of course, keeping an eye on their dual mandates. They are looking at the tariffs, which they admittedly said the downside would be perhaps more than what they had anticipated. Some sobering words there from the Fed chair. You could see the NASDAQ down 3% on the day. And in fact, the Russell 2000 small caps remain were the best performers.
Yeah, and I think that shows you that this is partly a valuation-driven sell-off, not necessarily all about economic fundamentals.
All right, so joining us now to discuss more is Jonathan Levin of Bloomberg Opinion, who keeps an eye on markets and keeps an eye on companies. And Jonathan, how would you characterize this stage of the decline that we're seeing in markets? Because it's certainly changed from what we saw last week before the pivot and the pause on the 90 days for the tariffs that President Trump had announced.
Yeah, totally. We're still in the chop phase here. Like, we've had a trigger event. We're going to have a series of aftershocks. I don't know that we've officially had an aftershock yet. And then, it's going to be a waiting period where we wait and see what is the effect on the real economy. So, my read is, we're still waiting essentially to understand what the policy itself is. That seems to change day by day. And then once we get some certainty around that, if we ever get some certainty, it's going to be like, what does this look like in the real data? What does this look like in the earnings reports? And of course, we'll get some forward guidance on that this earnings season, but still too early to see the concrete impacts.
I get to the sort of the age-old question, John, about this idea of sort of what matters most. Is it the contours of that policy or just some certainty about what it is?
Well, both. I mean, even if we had perfect certainty, it's hard to believe that anybody would be, jumping up and down in glee with a 25% effective tariff rate. And we're literally talking about that as a possibility. We're literally talking about changing the global trading system back to something that we haven't seen in 100 years. So the magnitude of this is huge. You really need to have a big walk back, and B, some certainty that walk back is sustainable for markets to feel good about this in the near term.
Jonathan, you wrote a column today that really reflected on the unusual step that United took in offering dual guidance for the full year. This base case that it offered and also a recession case, a bear case. In doing so, it provided a little bit of transparency, giving a pretty wide range of the possibilities for this year. What's the risk, do you think, of letting investors in on the downside option?
Well, I mean, kudos to them for being intellectually honest with everybody. I think, look, it just goes to this uncertainty theme that Scarlett, you and Romaine have been hitting on your show here. We're in this environment where, companies can't really tell us what's going to happen. We've been living with this security blanket of corporate guidance forever, and it just stands to reason that investors are going to have to demand a little bit more of a risk premium in this environment where they can't honestly tell us what things are going to look like 1 quarter out, 4 quarters out.
Yeah, and we should just remind folks, I mean, the earnings season's just getting started. I feel like the companies that maybe had a little bit easier in giving guidance have already given it. Here, it gets a lot harder as we move forward into next week and beyond. Jonathan Levin, Bloomberg opinion columnist, down there in beautiful Miami, Scarlett. Meanwhile, we're here in chilly New York City.
I know, it's already warm, he said.
Yeah.
Can't imagine that.
Yeah, rubbing it in here. Anyway, a down day for markets. Volume is light, a holiday shortened week. Remember, tomorrow will be the last trading day of the week. That doesn't necessarily mean there won't be catalysts. All eyes still on the relationship between the U.S. and China. And will they or won't they actually meet? Dan Tannebaum over at Oliver Wyman going to be joining us after the break. This is Bloomberg. All right, it's been 2 weeks since President Trump's Liberation Day, where he rolled out all of those tariffs on all of our big trading partners. And, well, he's still waiting for a call from Xi Jinping. Well, maybe those potential talks could be in play. Bloomberg is reporting that China is open to talking to the White House, but only if the White House shows more respect and is willing to address some specific concerns, particularly involving Taiwan. This as Beijing names a new trade envoy that maybe could help jumpstart things. Daniel Tannebaum joins us right now. He's the head of the Global Anti-Financial Crime Practice at Oliver Wyman. He's also a senior fellow at the Atlantic Council. All right, let's get right to it. What does China really want here? Because just to say, be nicer to us and, don't talk about Taiwan, is that enough to get them to the table?
They asked for a point person as well, which I think a lot of people would welcome at this point. Is it enough? I mean, there's a lot of unpredictability, as we've all seen, as the markets are evidencing. I think having a clear path of what does the U.S. really want, and we even heard the EU delegation that was talking about the trade deal doesn't fully understand what the Trump administration wants. I don't think China is any different, but they are really responding in kind because they learned from all of the tools that the Trump administration began imposing against them.
Well, that's what I'm curious about, is the retaliation from China. I mean, there were reports here basically telling their airlines not to take any more deliveries of Boeing planes. There's been a lot of rumors about other pockets of its economy in terms of cutting off business with U.S. companies. Is that going to be the primary tactic they take?
I mean, they're following how the U.S. playbook operated. To that point, on trying to not buy or service American aircraft with American parts, how is that going to work? Because realistically, how are you going to maintain the aircraft? You will need to buy parts unless you're making them yourself, which Russia learned how to do. I mean, the U.S. had been focused on the critical minerals, invoking 232 as an investigation to really look at what types of issues we're seeing in our supply chain. But China's threatened to withhold critical minerals. The U.S. buys 70% of its rare earth minerals and metals from China. Where is it going to offset that?
Yeah, these are all open questions, and hopefully we'll be able to get some resolution on all of these. You mentioned the Section 232 investigations. The administration is using that as the justification to launch all kinds of investigations into different sectors and presumably impose tariffs. Is there any limitation to the use of that rule?
I think there's precedent. I don't know if there's limitation, and that's, I think, what we've been dealing with a lot. Section 232 have been used to impose tariffs related to steel, aluminum, automotive, now semiconductors, and a look at critical minerals. How broadly can it be used, I think, is a question. But the pivot to 232 is also important. It tips the hat that the IEEPA-based tariffs might be running into challenge as we're seeing more litigation pop up. challenging the efficacy of the national emergency versus 232, which has been used historically more to drive tariff strategy.
So what happens in those legal challenges? Can you go on with what you've been doing up until there is a ruling on that?
Well, I think you have to follow the letter of the law and what the courts say, although that might be called into question a bit more at the moment. I mean, the challenge with IEEPA is the president declares a national emergency, but it's been related to the American economy, fentanyl trafficking, immigration. And given all of the back and forth on exemptions that are given, it does really question how significant this emergency is, which may create some doubt in courts' minds on whether IEEPA was legitimately used in these instances.
Who becomes the final arbiter in all this? Because I feel like in the past, yesterday we were talking about the 31st anniversary of the WTO, of the signing of the Marrakesh Accord. And I know the WTO has been kind of defanged a long time ago. But who is that kind of global arbiter right now?
There is no global arbiter right now. I mean, that is the challenge. I mean, you've really got kind of a U.S.-China trade war with a whole bunch of other parties that are trying to figure out how to basically adapt as best as possible. I do think the U.S. and China will come to terms at some point, but this kind of you call first approach, I mean, someone will actually have to make a legitimate move here. The measures and response from China today does seem like they're balancing how strong to respond. But again, I mean, things can change really quickly on this issue.
Is there a sense, though, that China can sort of recoup whatever it loses with America by trying to create closer partnerships with Europe and other parts of the world?
I don't know if it can recoup, but remember, the American consumer needs goods to be made in China. China is making them and can sell them elsewhere. So there is a bit of a lever that they have against the U.S. that may be more meaningful. That is the concern right now of whether these cheaper goods get dumped across the EU, which there's a focus on that at the moment. I do think ultimately they'll come to terms. It's just what will that look like? And honestly, seeing that the president hadn't responded so significantly to what China came back with today, I take as some positive for the moment. But, you know, who knows?
Who knows? And I mean, personnel is policy, as we learned from the first Trump administration. So I guess as China indicates it's open to talks, what do we know about who is likely to be leading those negotiations on the U.S. side? Because whoever leads it, you could get very different outcomes, right? It could be Peter Navarro or Marco Rubio or Elon Musk.
I think there's probably a lot of hope that it's Secretary Bessent is driving the negotiations. And honestly,
he says he is, right?
If you say so. I mean,
he said he's taking the lead in trade negotiations overall. I should be clear.
But I do think that does seem to be the dynamic that's shifting. Navarro seems to have slipped into a backseat. Bessent has been doing a lot more outreach on this topic, obviously has a lot of experience in this space and is a bit more balanced relative to the different camps within the Trump administration. But we don't know. That is to the point. Who is the point person?
But what is Jermaine Greer doing right now? Because I thought he kind of had the ear of the president. He seemed to have the respect of the president, at least.
Yeah, I mean, look, the USTR is certainly part of this, but that is a bit of the question, is who is really on point for all of these issues. You've got State, Commerce, Treasury, the National Security Council, other advisors, USTR, and there's a lot of differing opinions that we know about within this administration on approach.
I do have to ask you before you go about just sanctions in general and how do I put this delicately? Maybe the idea that some folks are trying to find ways around them. And this was kind of raised today because of the NVIDIA announcement that they were going to write off the $5.5 billion in chips here. We already know, anecdotally, that there have been some workarounds for China and others to get their hands on things that they're not supposed to get their hands on. Is this going to become more of an issue, more of a mess?
Well, I think tariff evasion is something to look to. And as I think about it, there really isn't a part of the U.S. government that's equipped to police that. So you'd have to stand up a team within the Commerce Department to really look at tariff evasion, much like OFAC at Treasury looks at sanctions evasion. But I do expect, and again, everyone's waiting for smooth sailing of some path forward that's a bit more predictable, but I do expect you may see countries and companies trying to look at ways to game the system, and someone will need to be stood up to actually police that.
All right, Daniel Tannebaum, always a pleasure speaking with you and getting your insight. Head of the Global Anti-Financial Crime Practice over at Oliver Wyman, as well as a senior fellow at the Atlantic Council. And for more on the supply chain impact of tariffs, we want to bring in our next guest, Izzy Rosenzweig. He is founder and CEO of Portless, which is a logistics company that helps customers cut down on unnecessary shipping and fulfillment costs. Izzy, great to speak with you. Can you give us a little bit more of an idea of how your company works? How do you do exactly that, cutting down some of the red tape and some of the multi-step processes currently involved in bringing product over?
Absolutely. First of all, thanks so much for having me. Traditional supply chain, let's say a brand will buy 10,000 shirts, put it on a boat, wait 2 months to get across the water. Then when they bring it to the border, paying import taxes day one as it gets to the port. Then they're getting and selling their goods over 4 to 6 months. Portless takes a different approach, and it's actually the same model that powered Shein to be one of the fastest growing commerce businesses in history. We say, don't put your goods on a boat. Bring it to our facilities. We have facilities in China, Vietnam. We'll get it 1 to 2 days after production, which means you don't need to buy 4 to 6 months of inventory at a time. Once we get it, you sell it to your customer. We'll pick, pack, and have that order delivered on average 6 days across the continental U.S. Consumer gets a local experience, USPS tracking number, or one of the regional carriers. And from a consumer perspective, 6-day delivery, local experience. But from a brand, less inventory needs because you're near the factory. You don't have 2 months on water, as well as you don't need to pay import tax day one. That is massive right now. We spoke to a brand yesterday that's about to import $1 million worth of goods into the United States. They would need to come up with $1.4 million check to pay the taxes. They don't have that, which is why they're coming to Portless.
So Izzy, I mean, Shein was able to do this, use that model and also exploit the de minimis loophole, which avoided import taxes. Yep. How do you do that now that that loophole has been closed?
Great question. So first position we say is it's not a loophole, it's the law. There was a law de minimis, which any order under $800 was import duty free. Now, people said this is going to kill Shein. Fundamentally incorrect. Yes, they're going to have to pay import taxes like every other retailer, and they're going to have to raise their prices like every other retailer a certain amount of money. But keep in mind, those goods are low-cost goods. $5 dress, $10 dress. So the $5 landed cost goes to $12.50, a $10 goes to $24.50. But there's still plenty of room of margin. The reason why they are fundamentally they run the most efficient supply chain model. They have inventory near their factories. They almost have no excess inventory. Now they also have a financial advantage, where traditional brands are paying millions of dollars day one when it hits the ports. Shein's only paying it when it crosses the border. So yes, import tax is going away. That's fair game for everyone. They still have the financial advantage and the supply chain efficiency of not having excess inventory.
Have you seen more of a sort of presence in the United States? And the reason I ask is there's been a lot of anecdotal evidence that some of the companies that we've been talking about have actually set up at least warehousing here in the United States to try to blunt the potential increase in costs.
We've seen that mainly with Temu, but I put Temu in a very different bucket. Temu was taking market share from dollar stores. And if once you're competing with the dollar store, every 50 cents matters. Versus Shein, let's say they're comparing against Zara or H&M, they have plenty of margin to still make money and be cost effective. Temu, on the other hand, pennies matter. Now, Temu is going after a more aggressive goal. They actually want to compete against Amazon. Right now, they have 80% cross-border business, 20% local business. Their vision is to get to an 80% local, 20% cross-border. That's extremely ambitious. However, they do have the balance sheet to pursue that.
Is there a sense here, and I know, Izzy, that your business has made a big made a big bet on China, and there's no sense that that's going to go away completely. But when you consider some of the companies that have been looking for other alternatives around Asia and even into Latin America and Africa, do you anticipate that we're going to start to see Portless maybe shift some of its attention there?
Absolutely. We've already been in Vietnam for over a year. We're going to be in India by the end of this year. End of the day, this is an evolution of supply chain for e-commerce, and you have to run efficient supply chain in every part in order to be successful in this chaotic world. So as long as there's an airport, Portless will be there to support e-commerce brands near their factories, 6-day delivery, but massive advantages for cash flow.
Let's talk a little bit about what kind of demand you've seen from some of the brands and some of the companies, particularly in the U.S. I know most of the companies you work with are U.S.-based brands, but what has that demand looked like in the past week or so?
We've had our busiest 7 days, or really since Liberation Day, than we've ever had before. Some of the biggest brands in America, we can't say their names, are under NDAs, are now reaching out. Because before, there's a balance sheet component and a P&L component. But now the balance sheet component of paying duties day one is out the window. It's insane. So now those brands do not want to pay millions of dollars day one. They rather either put into bonded facilities in the U.S. or leverage our facilities in China and Vietnam don't pay import tax day one, and then ship goods 6-day delivery from near their factories. So we've never been busier. And understandably, it is crazy. How could a brand pay import tax day one on 145% tariffs? That's not sustainable.
So essentially, this is just-in-time delivery as opposed to just-in-time manufacturing. Izzy, really appreciate your joining us today. Izzy Rosenzweig is founder and CEO of Portless. And we talk about all these, I don't want to say workarounds, but all these strategies that companies can use as there's still ever more uncertainty as to what the trade picture looks like, because China has reached out insofar as it said that it's open to talks. It wants a point person from the Trump administration. It wants the U.S. to stop bad-mouthing it, but we haven't had a response just yet. But what we do know is NVIDIA making clear that it's not able to export those chips that were designed specifically for the China market.
Yeah, and the problem is the workarounds, and I think Dan Tannebaum kind of put it best here. What is the enforcement mechanism right now? So you're seeing the pull forward. You saw that, of course, reflected in the retail sales numbers we got this morning. You're seeing that, of course, in wholesale inventories. And at some point, you have to just acknowledge the fact that there are sort of secondary ways to get your hands on some of these things.
All right, let's take a look at how markets closed on the day. Down, down, down for the major indexes. You have the S&P 500 closing off its lows, but it did take a big leg lower when Jay Powell made clear that the Fed is in no rush to cut rates, losing 2.25%. Chipmakers were really the ones getting hit the hardest, down 4.1% for the Philadelphia Semiconductor Index.
All right, we'll be back in a moment. This is The Close on Bloomberg.
Netflix reports results tomorrow after the market close, and David Joyce of Seaport Research Partners today notes that the streamer offers both secular growth and defensive safety, the best of both worlds. Joining us now is David, who has a buy rating on Netflix with a price target of $1,025. So the theme here is that Netflix is set to weather the macroeconomic turmoil. How will Netflix make this clear? How will that manifest in its forecast?
Well, they've already provided some guidance for the full year, but that was before we had all of this tariff news that could be impacting the recession later on. But I think that whenever they did provide some guidance, that was really still providing themselves with some room to underpromise and overdeliver. One of the big areas where they could be delivering that growth, not just this year, but into the future, is really the secular theme for the company, that they're taking advertising share. They're still in a pretty nascent spot, but I think that the advertising opportunity on the huge 300 million subscriber platform that they have is really going to be a pretty significant driver for them.
And do you think they're able to charge higher advertising rates as a result? When do we expect that to start to show up?
So I think they started out charging rates that were too high, but they've come down to something more palatable with the peers. And I think that has brought advertisers into their platform. I think it's probably still too early for the company to be discreetly disclosing their ad revenue. But I think we've triangulated on the sizing of how much they'll be generating this year. I think that they'll roughly double, maybe a little bit last year. I think they get to $3.2 billion this year, but it's going to be back half weighted. I think we have heard that based on the recent tariff news, advertisers did start pulling back in the near term. But I think that they'll be accelerating, and the company also has talked about a view to getting to advertising being 10% of their revenues in a few years.
With regards to your outlook for what those advertising numbers might look like for the quarter, at least, you lowered that general guidance, right? I mean, you were looking for something a little bit more. You're coming in a little bit less. Why did you make that change?
Well, I think that in part advertisers have been pulling back, but you also have roughly half of new subscribers coming onto the cheaper ad tiers. The company is not making up for it yet in the ad tier pricing versus the ad-free pricing, but that will come in time. So it was a shift of assuming that more of the subscribers are coming on the ad tiers at a lower initial price and a little bit less of the ad revenue here as a result of the broader economic implications in the near term. But as the ad tier subscribers grow this year, and it becomes evident that this is where people are spending more of their time if we do go into a recession, I think that's what's going to help accelerate the ad revenue portion.
I'm curious, David, when investors sort of look around for safety in this market, assuming the market turmoil continues, do you look at Netflix as being kind of one of those, if not recession-proof, at least recession-resilient type of stocks?
I do. I think that is an apt term. Again, the issue that they would face in a recession is broader advertiser pullback. So even though that is a growth area for Netflix, I think that's an area that is still taking, that area meaning the broader connected TV and streaming market. I think the ad spend should grow in the 14 or 15% range this year, while advertising and other media forms are possibly going to be declining. So ad budgets are moving into this kind of a platform. In this platform at Netflix specifically, having 300 million subscribers around the globe is where advertisers are going to want to go for a return on investment. So I think that because people are going to keep a Netflix service in good times and bad, it is a very cheap form of entertainment if you compare the $18 a month cost of an ad-free tier. And assuming two hours of viewing a day, that's only 30 cents per day of entertainment.
All right, David Joyce, senior analyst over at Seaport Research Partners. A nice preview of Netflix. Of course, we'll have full coverage tomorrow after the bell here, me and Scarlett, on those earnings out of Netflix. Again, we're not going to get those subscriber numbers that everybody paid attention to. But still, we're talking about $10 billion in revenue for the first quarter based on the average of analyst estimates. And more importantly, a pretty strong profitability and cash flow. Cash flow at $2 billion. EPS looks like $5.68 is the consensus.
Yeah, Netflix is in an enviable position because if people downgrade the packages they have, they'll probably downgrade to the advertising tier, which brings in more revenue for Netflix. And it's exactly what they want to see.
Right. So now they're looking really smart that they did the ad tier. I do wonder, though, is this going to be sort of if Netflix does seem to do well, can we also extrapolate that Disney will do well, Warner Brothers will do well, some of the other streaming services?
But Netflix has become a utility, and I know that Disney is for a lot of families, but by and large, Netflix is kind of the service that you have used to replace whatever cable package you had in the past. And a lot of the other ones feel like add-ons after Netflix.
All right, Netflix, of course, one of the big potential market-moving events tomorrow. We're going to set you up for some of the other things that could move the market as well over the next 24 hours. This is Bloomberg. All right, here's what could potentially move the markets over the next 24 hours, and we start with earnings.
Yeah, we've got a lot of them, and across different sectors. Blackstone, D.R. Horton, the home builder, United Health, which, of course, medical costs will be under scrutiny, as well as American Express, which will give us a good, clean read on consumer spending.
Yeah, I'm really curious to see what they have to say as well. We're also going to get Netflix, which we were just talking about. We're also going to hear from the head of the European Central Bank.
Yeah, they are expected to cut rates, and, of course, Christine Lagarde will be holding a news conference. We'll be checking that out as well.
Do you think she's going to be more candid than Jay Powell? Don't answer that question. Also, 8:30 a.m. right here in Washington, we're going to get a read on U.S. housing starts. This could actually be an interesting barometer, too, because I'm always told that, all these companies, these housing companies, they're much more long-term.
Yes,
but are they being affected by some of the short-term issues?
I'm sure they are. And that's going to be a good indication of what happens. Jobless claims as well, especially with the labor market under focus.
Also, President Trump also going to have another visit from a world leader, this time the Prime Minister of Italy. We'll have all of that coverage tomorrow right here on The Close with myself and Scarlett Fu. If you're interested in politics, stick around. Kelly Lyons is coming up next on Balance of Power, right here on Bloomberg.